This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, Portfolio Managers, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Well done. Welcome to episode 313. The band is back together again. Did you guys know that 313 is my favorite number?
Why?
Actually?
It actually is. Ben, you might know
story.
I
why.
don't know.
Anyway, my birthday is March 13th.
There you go.
So we're setting up the phone system years ago in the office. We get to pick what your extension number is. And they said, well, we'll make you whatever it was. 102. I said, can it be 313? They said, sure, you can be 313. So I've always been extension 313 on the phone for my birthday. So now you know. There's my favorite number. So we finally get to 313.
You've been waiting for this for years, hey?
I've been waiting 6 years for episode 313.
Congratulations. You made it.
Anyways, it's great to have the band back together. And for those on YouTube, Mark, your backdrop is phenomenal.
Oh, thanks. Yeah.
Nice Fender up there.
Yeah, I got my guitars up. Actually brought the amp downstairs. Still got to plug it in. But took me a while to get the office. I moved my office from a spare bedroom that we had into my garage. We've got a 1-year-old daughter, and she's eventually going to need that bedroom. So my wife kicked me out of that room, and I had to rebuild downstairs. And through just apathy and other priorities, it took me a while to get the thing set up, but here we are.
Ben, you want to tee up today's conversation?
Sure, yeah. We're going to cover when it makes sense to hire a financial advisor.
That's pretty factual-based tee up. Do you have any backstory or inspiration or anything to share?
No, it's kind of a derivative, I guess, of a topic we did a while ago, or I guess a few topics we've done at different points in time. But it's, I think, a different take on it, and it's kind of taking the perspective of even if you don't have an advisor right now, or even if you don't need an advisor right now, under what circumstances might it make sense to hire one?
I do get that question a lot. Like, people reach out and say, and they ask that exact question, like, when does it make sense? And sometimes it makes sense now, and sometimes it absolutely doesn't. So I think this is going to be a very enlightening episode.
Hope so.
Love it. Okay, with that, let's get to the episode. Okay, Ben, let's get going. When should you hire a financial advisor?
All right. So obviously, low-cost index funds, which we talk about a lot, make investing easier today than it's ever been, I think is pretty fair to say.
Easier. It's phenomenal today.
Yeah,
I'm saying this to
crazy.
people lately. Like what's available today in the marketplace is simply mind-blowing compared to the stuff we had 30 years ago.
Yeah.
And it's super cheap. Even if you pay the same price, it's much better quality. Anyway, keep going.
Yeah.
Also makes you wonder a little bit about expected returns. If investing's that much easier and everybody's doing it, you'd expect expected returns to come down a bit, but it's another topic. There's a paper on that, on how everybody indexing would affect expected returns, but anyway, separate topic, different day. So investing has gotten easy. We've said before, investing is kind of solved, at least functionally. But obviously, the other important thing is that household finances go way beyond investments. We've talked about this many times before. Solving investing does not solve household finance in totality. And I think that's one of the reasons why financial advisors continue to exist, despite the growing acceptance of index funds. And I mean, the other thing is a lot of financial advisors themselves, for their personal stuff, but also for their clients, and I would probably say that the good financial advisors are recommending index funds as well. So that just kind of goes to show you that there's a lot of other stuff other than choosing that specific product that goes into financial advice. Index funds are not a financial plan. They're a product that helps to solve implementing one component of a financial plan. But considering other aspects of financial planning is what an advisor is ideally going to do. But then even still, I don't think everyone needs a financial advisor. I do want to specify before we keep going that I'm thinking about a financial advisor who's going to manage your investments for you. When we say financial advisor is a pretty loose title. It's gotten a little bit more regulated in Ontario recently, but even still, it's fairly loose. Like, can mean a lot of different things, basically. So I'm thinking about someone who is going to take your investments and manage them for you, and then give you ongoing financial advice. So that's distinct from like when should you go and visit a fee-only financial planner to get a financial plan done for you. We're not talking about that. We're talking about when should you delegate your investment management and financial planning to a full-service financial advisor.
It's also distinct from what I think a lot of people expect when they seek out a financial advisor. As we've said many times, I'm sure you guys agree, whenever you tell someone what you do, which I try to avoid, the question back is always something predictive. Always.
Yeah. Well, yeah.
Why, excuse me, why do you try to avoid that? You just don't want to get into the discussion, or you think it's very difficult to convey?
It's always about, my neighbor just asked me 2 days ago, what stock should I be buying these days?
Yeah.
He knows what I do. I've told him many times. He's still he can't help but ask. Great guy.
Yeah.
But I'm not about to entertain that and try to explain why that doesn't exactly reflect how we advise people.
I'm similar. Like, I have friends, or like friends' parents will go over for dinner and just get into conversations or whatever, and you're like, oh yeah, how do I explain what I do? So I say I'm a financial planner and I deal with personal finance. Often it gets into the portfolio discussion, and that's always the question, like, oh, what's going on in the markets, and what's hot, and what should we be doing? It's like, oh man, this could be a really long conversation.
But do you ever successfully, sorry Ben, don't mind us, but do you ever successfully convince them the merits of what you believe in?
I won't change their behavior more than likely, right? But I've had conversations with like my friends' parents who are stock pickers, for example, and when we explain things like market efficiency and how markets work and risk, they find it very, very fascinating. And I've had them come back and just want to continue talking about it at subsequent like dinners and hangouts. But I don't think any of them have actually, changed their portfolio as a result, but they're definitely fascinated in that way. For a lot of people, it's like a totally foreign way of thinking about how markets work, right? They just think that you just buy the good companies and that's it, right? But yeah, anyway, sorry to totally derail your thought process there, Ben, but I just thought I'd ask.
No, well, the funniest answer that I've heard somebody have for that question of what do you do is, I sell life insurance, and then nobody wants to talk to you anymore.
Yeah. I've used that a couple times, I confess.
Nice.
I'm a life insurance agent.
Yeah, less interesting than anything related to financial markets.
And that's no disrespect to life insurance agents at all. It's just
Yeah.
I know people don't want to talk to life insurance agents.
Yeah.
Yeah. Okay. So anyway, back to the topic. Financial advisors let you delegate the majority of your investing and financial decision making and the related ongoing tasks, and they monitor your financial situation. That's a pretty broad overview, I think, of what a financial advisor does, but I think it's also a pretty good definition. Now, that combination of services can be useful for a lot of reasons, and I'll come back to those reasons in a sec, with supporting academic research as usual. But first, I want to mention subjectively why people say that they hire a financial advisor. This is a very different thing. Like, we'll get into the evidence in a sec, but I think this is interesting. The theory and evidence, actually, in this case. So Morningstar analyzed 312 individual long-form responses to the question, please list some reasons why you hired your advisor. And they manually analyzed these, and they sorted them into various financial and emotional motivations for why you hired the advisor. The top overall motivations were to alleviate discomfort in handling financial issues and the desire to achieve a specific financial goal. And then the next most common motivation was behavioral coaching, access to behavioral coaching. Overall, in their analysis, non-financial motivations were identified more frequently than financial ones as the reason that somebody hired an advisor. So I think that suggests that purely quantitative assessments of financial advice probably miss the mark. There's a whole bunch of those out there that different fund companies and like Morningstar has one too, trying to quantify the value of financial advice. But I think research like this really shows that it's really hard to quantify, first of all, because it's really hard to know what the counterfactual was. What would that person have done otherwise? Like, what's the baseline that you assume financial advice adds value over? But then the other piece is there's this big subjective component that I think is a lot harder to quantify.
Well, even then, it varies so much by individual, right? Like I've explained this to people before. Like, I can have two clients that are in very similar stages of life and similar financial circumstances, and the value that each of them derives from the relationship will be totally different based on the individual decisions and pathways that they take, right? So those studies are out there, but it's yeah, I'd be very hesitant to try to quantify it, even for an individual, let alone like a cohort of people.
Yeah. And I think it also touches on fees. Like fees are obviously a big topic when we're talking about this type of financial advice. And it's something that's gotten a lot of attention, which I think is warranted and is a good thing. But it's also like you don't need to expect to get, 1.5% back for spending 1% quantitatively, because a lot of the value of financial advice is going to be qualitative.
Mm-hmm.
I've had that conversation in the past where someone's like, okay, I'm going to pay you 1%. Like, show me quantitatively why it's worth it. Show me the 1.25% I'm going to get back in whatever tax savings and so on and so forth. But I don't know if that's the right question. And I mean, this research from Morningstar suggests that it probably is not the right question. Anyway, Morningstar did another study with 620 survey responses this time, again, long form, and they did manual analysis. This time responding to the question, please list some reasons why you continue to have an advisor. So instead of why did you hire your advisor, why do you continue to maintain this relationship? In this case, discomfort handling finances as a broad category, with specific reasons as subcategories of peace of mind and money makes me nervous. So that was the top. Discomfort handling finances was the top overall response, followed by the quality of the advice. So they continue working with their advisor because they've gotten good advice from them. And then behavioral coaching. So in this case, they didn't hire their advisor because they wanted to get behavioral coaching. They continue to work with them because they have been receiving behavioral coaching. Those subjective responses suggest, again, that if people could learn the necessary skills and increase their confidence in their financial abilities, they might not need financial advice. And that's true. I mean, people listening to this podcast will feel that because they're listening to this podcast to gain those skills. But that's kind of true of any skill, right? But the thing with gaining skills, again, using people listening to this podcast as an example, they're taking their time that they could be spending to learn about other stuff to listen to this podcast. Gaining any skill comes at a cost. So this is where we start to get into some of the academic literature on this. That trade-off is addressed in a 2016 paper in the Journal of Financial Economics. The paper's titled Time is Money, Rational Life Cycle Inertia and the Delegation of Investment Management. So they talk about how empirically there's this phenomenon called investor inertia, where investors devote only sparse attention to their personal finances. And they suggest that this can be explained by the time costs required for being actively engaged in managing your personal finances. So to address that inertia, to address the lack of doing stuff with your personal financial situation, people can do one of two things. They can either delegate their financial decision-making and portfolio management, or they can use their time to gain the necessary skills to do it themselves.
It's super fascinating to hear it described that way. I have a couple of clients, and one is a good friend of mine. He's brilliant. He's an engineer, high-income earner, very capable, very highly educated. And I've always described him as financially apathetic because it was the best, term that I could come up with. He's the type of client where we go into meetings and he just tells me, like, I don't care what you do, just do it. Like, I trust you, it's all going to be okay. And to your point, it's not about capability, it's about potentially about the trade-off, right? And the cost of their time and their interests. I mean, he could spend the time to figure it all out himself. I mean, the entire compendium of human knowledge is on the internet. Anybody can go and figure anything out these days. But he just has absolutely no interest in it. So it was really interesting in reading the notes before our conversation today to see it described that way, because it describes him perfectly.
Did he do a deep dive from an engineering standpoint on how you operate, or is it a friendship-based trust?
It's friendship-based. I would say with that particular client, it's friendship-based. I have another client that's somewhat similar, also very highly educated, very capable. And for them, I think it's trust-based as well. They're not an engineer. They work in a different field. They're a physician. But I think that one's trust-based as well. But yeah, my friend wasn't. We've always talked about money, and he's known me for years and years and years. And so I think he just automatically said, like, just take my money and figure it out, and just call me when you need to, kind of thing.
Whereas I have an example of someone who I would say is financially apathetic, but did the deep dive, checked all the boxes, built trust, and then he's off to other things he wants to learn about. He doesn't want to relearn and redo. It's too monotonous to continue to do what we do for people.
Yep. Interesting.
I mean, that's one of the things about all of this is that it's an ongoing process. And this paper addresses this too. They talk about how this isn't something you just learn once, because your situation changes, tax laws change, as we've just seen recently, financial products change, new products get created. So there's always things that you need to be learning about in order to do this stuff well. Anyway, so they model that in their paper, that there's this cost to acquiring this knowledge, and the trade-offs, I think in their model, they're trading off against, I think it's leisure time and job-specific human capital. Now, so like you mentioned, a couple people with specialized professions, Mark. Depending on what they do and what their career stage is, the opportunity cost of time is going to be different for each person, and that's what this paper is kind of trying to model. So they build and solve a realistically calibrated life cycle model where the time cost required to manage one's portfolio is traded off with the opportunity to accumulate job-specific knowledge and to enjoy leisure time.
That's
so
cool.
Investors in the model, yeah, it is cool. They also have the option to delegate their portfolio management for a fee. The attractiveness of delegation varies over the life cycle. In related research by, it's either the same co-authors or a large overlapping group, but in another paper where they kind of reference this previous paper I was just talking about a lot, so very, sort of similar research, but looking at some slightly different stuff, they show that consumers are always better off in their model when given access to a financial advisor, when they can delegate, but the gains to delegation decline with age. So specifically, they find that workers can expect a 1.07% improvement in lifetime welfare when they have an opportunity to delegate, accounting for fees. This includes the cost of fees, to delegate their financial decisions to an advisor from the start of their working lives at age 20. So they do find the biggest welfare gains come if you can delegate as soon as you start working, which can be problematic because people at that stage don't have money to invest, which makes it hard to start a relationship with an advisor in many cases. But anyway, it's a separate issue. And then on the other hand, in their model, they find that when the delegation option is introduced just prior to retirement, so at age 60, so they say you can't delegate until age 60, the lifetime welfare gain is much smaller. It's only 0.02%. So they conclude that it's better for investors to have an early opportunity to hire financial advisors, since access to financial management early in life can produce important improvements in lifetime wealth and well-being.
It's very fascinating to me that the gains were so muted later on
in this model. So keep in mind what in this model, the opportunity cost of time with respect to how it contributes to the value of your human capital is really what's driving the trade-off here.
Okay.
And when someone's retired, that trade-off basically goes away because when you stop working, your future income goes to zero. So there's no more notion of increasing your human capital.
Different value trade-off.
Yeah.
Yeah. But I've got other research on why financial advice starts to matter more for different reasons post-retirement.
But does that number still count the leisure trade-off and the job-specific skill training trade-off? Because obviously you'd think the leisure component of it would go parabolic at that point.
I think it does. The number I just talked about was lifetime welfare. So that does include the leisure measure.
Huh.
Yeah. But like again, in retirement, you don't have other stuff to do either. Well, your time is less limited, right? So
yeah, that's true.
I think that trade-off is less painful, probably. Okay, so so the other thing that's worth mentioning is that delegation's ability to improve wealth and well-being. This is my own interpretation, I guess, or addition. This is not based on the paper we just mentioned. It's just kind of logical. That relationship, delegation's ability to improve wealth and well-being, is going to be increasingly relevant with increasing complexity. Like a single person saving just enough to max out their TFSA and investing in a Vanguard asset allocation ETF, they don't have that much learning to do in order to manage their finances, although they could have other stuff like their insurance and legal planning and things like that would maybe take a little bit more learning. But anyway, just for the spirit of the example, simple situation, less learning to do. But if you take someone with a family with multiple kids, maybe they've got a taxable investment account, maybe they've got a family trust or a corporation, all of a sudden the learning curve is like, that becomes something that not even a single competent professional would know everything about.
Mm-hmm.
Like you might have a team of a tax professional, a legal professional, and a financial professional all giving you advice in those more complex situations. So to think that you can, level yourself up without giving up significant opportunity cost of time, I think that trade-off becomes pretty obvious with that increasing complexity.
On that note, I think in some cases that complexity is subjective too, right? Like I've got clients that I was just talking with yesterday, and from my perspective, it's not a very complex situation. It's two young individuals, no kids, both have pensions at their job, but they're seeing the complexity ramp up for them. But maybe it's because of this trade-off in time and leisure, right? So they've got a rental property, for example, and they're just starting to get a little bit overwhelmed with their own finances. So I don't think that you can draw a line in the sand as to where things are complex, because it's probably a reflection of those individuals' financial literacy as well.
Yep, that's fair. There was one paper that I found in the Journal of Retirement that looks at what is the effect of financial advice on household outcomes. So it's a 2020 paper in the Journal of Retirement. They use a survey of more than 4,000 working households to assess the impact of financial advice. And they find that households using financial advisors on average have higher incomes, are wealthier, married, more highly educated, more confident in their retirement planning, and more disciplined in their financial process. Now, all of that there could be some significant selection bias in there where those people are more attractive to financial advisors. So what the authors of this paper do is use regression and nearest neighbor matching methods to control for confounding variables. And they find, even still with the control for confounding variables, they find an approximately 15 percentage point increase in the retirement income replacement score resulting from the use of a financial advisor. So in that case, they seem to be confirming what the other more theoretical paper talked about, where there can be these overall welfare gains from delegation. And then a separate study looks at the effect of professional financial advice on subjective well-being. So those are the two things we mentioned earlier in the theoretical paper on what is the value of delegation. Well, you could have increased wealth through increased labor income, and you could have increased well-being through more leisure time. So in this paper, the authors find that people who receive professional financial advice tend to have higher subjective well-being, and that the association is stronger for households that experience an increase in income. Individuals who do not consider themselves financially knowledgeable, this kind of speaks to your point, Mark, where different people will get different benefits, and individuals that have a weaker internal locus of control and the lower degree of conscientiousness. Locus of control, I'm going to come back to in a bit. Some other really interesting research on that. Retired investors, we kind of talked about this already, they might gain less from delegation because their human capital is no longer a significant asset. But the other relevant issue that I think starts to become really important in retirement is the potential for cognitive decline. So there's a relatively recent paper out on this that found that older people tend to underestimate their own cognitive decline, and that those who have experienced a severe cognitive decline but are unaware of it are more likely to suffer wealth losses compared to those who are aware or did not experience a severe decline. So this study is looking at data from the Health and Retirement Study, which is a representative panel of U.S. population aged 50 plus. And they're studying the relationships between self-ratings of memory changes, assessed changes in memory performance, and wealth changes across waves of the survey. So the results of their paper suggest a causal role of unawareness of cognitive decline for wealth losses. And wealth losses among unaware respondents mainly reflect a decrease in the value of their risky assets. So like their, financial market investments. They also find that wealth losses are concentrated in the highest wealth quartiles, which is an interesting point. So they interpret their own findings as being the effects of overconfidence, where people who have experienced cognitive decline but do not realize it end up making poor financial decisions largely with their investments. Now, they do talk about hiring a financial advisor in this paper, And they point out that delegation itself is not necessarily the solution. And you kind of alluded to this earlier, Cameron, with the idea of doing a deep dive on the person before hiring them. Delegation itself is not necessarily a solution because it requires non-trivial cognitive skills itself to make sure that you're delegating to the right person.
Wow.
And then, of course, right. And then we also have conflicts of interest, which make that whole issue even more challenging.
So it's the timing of when you make the choice of advisor could impact your outcome.
Well, yeah, they're kind of saying that, if we're saying that cognitive impairment is a problem and we want to solve it with financial advice, it's not necessarily a solution because you need cognitive ability to choose a good financial advisor.
So if you've made the choice before the decline, obviously you'd be better off than making it during, because during you might choose an inappropriate type of advisor. That is so interesting.
Yeah,
not surprising, I guess, but it's fascinating.
Mm-hmm. We've got the trusted contact person now in the industry. This doesn't solve the problem because, to your point, you have to actually hire the advisor prior to some kind of cognitive decline. But I think the industry has made strides in this area. We've got, I think it's mandated now that advisors in Canada have to make a reasonable effort to add a trusted contact person to somebody's file. And the trusted contact person isn't like a power of attorney. They can't actually act on behalf of the individual, but they can be contacted by advisors in limited circumstances. Mm-hmm. If there's concern about things like fraud or cognitive decline, for example, then we can reach out to the client's trusted contact person and just say, hey, is this making sense? Is there an issue going on that we don't know about? So it's another line of defense against that. But again, you still need to hire the advice before the decline happens, right?
Yeah. Yeah, no, it's a great point that we have that requirement in place now.
Yeah.
Yeah, so related to the idea that you have to have cognitive capacity to choose a good advisor, other research has found that more financially literate people seek help from financial professionals, and that this effect is more pronounced among older people and those with more wealth and more complex financial positions. So the result of that paper implies that financial literacy and financial advisory services are complementary rather than substitutes for each other. I thought that was interesting. So people have to have some level. I think Mark Soth and I talked about this on Money Scope at one point, that even if you want to delegate to a financial advisor, you do have to be very trusting and end up trusting the right people, which is obviously, that's pretty messy. Or you have to have some baseline level of financial literacy in order to assess whether you're getting good advice or not.
That doesn't surprise me, actually.
Yeah, well, it makes sense.
Like if you just look at, I wonder if there's some kind of Dunning-Kruger effect to that, almost like just through my conversations with people online, for example, who start with, there's index funds now, financial advisors are basically going to be wiped off the face of the earth. And it's like, oh man, where do we even start? Like you know so little about what financial advice is. You don't know your own blind spots. And I think the more you know, the more you recognize you don't know. There's things you don't know, right? And that's probably an impetus for people to seek advice.
Yep. Something that I've definitely noticed being at PWL for the last 10 or so years is that there are lots of highly capable and financially literate people who eventually make the decision to delegate to PWL for lots of the reasons that we've talked about.
For sure.
Could be the opportunity cost of time. Maybe they want more leisure time in retirement. Or in many cases, it's been like a more financially literate spouse who wants continuity for their less financially literate spouse. That's a very common thing in relationships for whatever reason. I'm sure there's interesting research on that we could dig into at some point, but it's very common for there to be one more financially literate spouse in a relationship. And if they've been doing a successful job managing the household finances for their entire lives, in the event that they experience cognitive decline or an unexpected death, that puts their less financially literate spouse in a potentially difficult situation where they now are the person with low financial literacy trying to figure out who they can trust.
And those are super vulnerable moments for the surviving spouse too. And often the probability of them making a catastrophic mistake, and this is totally anecdotal, but I think the probability of them making a big mistake is very high in that period of time after something like the unexpected death of a spouse, right? And so they're thrown into this emotional turmoil. And then on top of that, they're given the task of managing the finances, which was a job that they were not all that involved in some cases. So I've had a lot of conversations with people over the past couple of years who have told me, I'm good for now, but in a few years, I'm probably going to hire you for this very specific reason that I'm the head of the household financially and I manage all the finances, and I'm worried or concerned about what happens if something happens to me. And they want that continuity, or at least they want to have conversations with their spouses to let them know, hey, if something happens to me, you need to go talk to Mark or to PWL. And even my friends who are advisors at other firms have told their spouses, like, hey, if something happens to me, go to Mark. And it's a huge honor, but also a huge responsibility. So I think just again, anecdotally, I've noticed those conversations for me have been quite prevalent.
Okay, so we've covered a lot of the big ones. There are a couple of other interesting ones. Some research has suggested that financial advisors do act as a commitment device for good financial behaviors. So one study that found that German brokerage clients with self-control issues, and they measured that by people who smoked cigarettes. And there's other literature on how people who smoke cigarettes do in fact have poor self-control. But anyway, they found that they were more likely to delegate their decisions to financial advisors, and that their over trading for these investors is reduced, their investment biases are mitigated, and their performance is improved.
That's the personal trainer effect.
Yeah.
Right? Like I said,
Yeah.
if it was as easy as just Googling information, we'd all have six packs, right? Like, like I have a gym right here. I know exactly what my diet should look like, how often I should exercise. There's a reason I'm only showing myself from the chest up right now. It's not a lack of information. Let me put it that way.
That's a good analogy. There's another study on German investors, similar concept, but in this case, they find that financial advice improves saving behavior. So particularly for households with low self-control, and it increases the ratio of stock market share in total financial assets. And then there's another one I didn't have in my notes, but there's another one on exponential growth bias, where people who exhibit exponential growth bias, like they're not good at thinking about compound returns over the long term, they tend to be more likely to delegate to financial advisors. It's another interesting one. Now, I mentioned briefly earlier that it's really important to note that not all financial advisors are the same, and many of them do have severe conflicts of interest that can affect the advice that they give, even if they're good people. Like, incentives are hard to fight against. So I think when seeking out a financial advisor, it's important to ask how they're paid. That's like one of the first questions to ask. In general, not always, but in general, those receiving commissions in exchange for selling financial products may be affected by conflicts of interest. Fee-based advisors, which is what PWL is, they charge a direct fee for their ongoing advice. That setup mitigates a lot of the conflicts of interest associated with selling financial products. If you're selling financial products that pay you a commission, you have to sell financial products that pay commission. And those products that pay commission tend to be much higher fee for the end consumer. Fee-based products tend to have lower overall fees. Anyway.
There's still conflicts there, obviously. Right?
100%. Yep.
I'm, as you guys know, I'm writing this, co-authoring a book with Dan Solon, and we've got a whole section in there on, for example, advisors like us who are fee-based and what our conflicts are. And I just think a great example is, should you pay off your mortgage or not with portfolio assets, right? And so we're incentivized. I think our incentives are aligned very well with our clients, but at the same time, to your point, it's incentives are difficult to overcome, right? And so if somebody who's a fee-based advisor is given the choice to say, keep more of your money in the portfolio, which generates more revenue, versus pay down a mortgage, for example. So I think there's conflicts in every model, but I think I agree that transactional-based relationships are probably the hardest of all conflicts to overcome.
Yep, definitely. It's also worth asking, I think, if the advisor is a fiduciary. A fiduciary is required to act in your best interest, which seems like it should be table stakes for something as important as financial advice, but it is not.
And most people think their advisors are fiduciaries. Yeah, there's actually, I don't have it at my fingertips, but I believe there's data on this survey of some kind. And most consumers of financial advice in Canada believe that their advisor is a fiduciary.
And not be, right? It doesn't make any sense not to be.
You'd think
That's
so.
the default assumption, right?
Yeah, and it's different in the US too. And I think a lot of people who want the answer to this question are reading like US-based advice, where fiduciary duty, I believe, operates totally different than it does in Canada. But in Canada, the only class of advisors that are de facto legal fiduciaries are portfolio managers, like licensed portfolio managers who have discretion over their clients' investment accounts within. We have something called an investment policy statement, right? But we have the discretion to make changes to clients' accounts. That's the only category that's de facto a fiduciary. But interestingly, courts have found that other advisors had a fiduciary duty in certain circumstances based on their relationship with their clients. And one of the things they look at is the level of trust that was placed by the client in the advisor. So it's the reason I bring this up is because you might ask your advisor, are you a fiduciary? And their answer might be no, because I'm not a registered portfolio manager, but they might in fact be found to have a fiduciary duty after the fact. Super complicated.
Yep. Yeah, it is. It is complicated. We do, it's not legally binding, I don't think, although maybe the fact that we've done it puts us in a stronger position of trust, which maybe does make it more legally binding. But we do this thing called CFEX certification, which is a Center for Fiduciary Excellence, which is this third-party organization that we pay to come and audit our processes and client relationships. And they dig through our client notes and they look at the advice that we give, and they give us the stamp of approval to say, yes, you're acting as a fiduciary. Anyway, so some firms do stuff like that to take that extra step to show that it matters to them. Okay, so I think that's the meat of the notes. So just to summarize, hiring a financial advisor can make sense if delegation is valuable to you. This can be the case if you're uncomfortable with finances and investments and do not want to dedicate the time to learning. For many people, the choice to delegate is rational due to the opportunity cost of time, and this is increasingly true as the financial situation in question gets increasingly complex. Hiring a financial advisor can also make sense to mitigate the risk of cognitive decline affecting your household's financial decisions as you age, and to act as a commitment device to reduce unwanted behaviors.
Yep, nailed it.
Nailed it. It was awesome.
The only other, I don't know if this fits into one of the categories you just described. Maybe it does, but I have had a couple people say that as the complexity grows, as the portfolio grows, they're concerned about the responsibility that they have to their family with respect to all of the financial decisions that are being made. And I think it comes from a place more of like liability than anything. And they're worried that if they were to make a mistake, it would impact the relationships they have with their family members. And so for them, it's almost like just an offloading of risk and liability than anything else. And again, maybe that fits into some of the categories you described, but for these people that mentioned it to me or proposed it to me that way, it was a different way of thinking about it for me.
That's kind of what Dan Harris described when he was on a couple of months ago. You know, everybody wants someone to worry with.
Yep. Exactly.
It was great. Okay, head over to the after show where 2 or 3 people will join us.
You say that every time. Do we have stats on who like drops off or who listens to the after show?
At least, I think we have 3 firm people that come.
They come only for the after show. They ignore the episode and
show,
just come for the banter.
People love saying that they're one of the three. It's a funny way of saying that they listen to the end. It's like a funny podcast inside joke.
Nice. Good trip, Mark?
Yeah, it was really good. So I was in Europe for 3.5 weeks.
I thought your tweet was excellent. The observations you made were excellent in your tweet.
It's so funny how social media works. Like that was like an off the cuff tweet that I wrote like just without thinking. And I think got like over 1,000 likes and 60,000 views or whatever.
What did you say?
I said something like, just got back from 3.5 weeks in Europe. Things I learned. Europeans smoke a lot. No tipping culture is amazing. Working public transportation systems are incredible. And there was one other point, right? Like just it was mostly, these are all true things that I was like really struck by. But at the same time, it was kind of just a throwaway tweet, and people loved it. And I heard from a lot of people who had moved to Europe or lived in Europe and who agreed with me. But yeah, no, the trip was great. We went to Barcelona, and we went down to Valencia, to Prague, where I went to a concert. One of my favorite bands called The Smile, and that was amazing. Prague's an incredible city, and to see a cool band in a cool venue was really, really fun. We went over to Stockholm, where my sister-in-law lives, spent 6 days or so there, and then we did a couple days in Paris, and then we came back. All with the kids too. They were troopers.
Don't you love Barcelona?
Oh man, what a city!
What a city!
All of them,
Yeah.
and like Paris and Barcelona. There's a lot of similarities, but Barcelona's incredible.
Cool.
Yeah, going back for sure. Going back.
I cut and pasted a tweet I saw this morning that I think Sam Rowe put out. I didn't know this, but NVIDIA joined the S&P 500 and replaced Enron back in 2001. Thought that was kind of cool.
Yeah.
Interesting.
Turned out well. Turned out very well, I'd say.
Yeah.
We had a nice email from Steve in London. He said, hey, Cameron, I just listened to episode 311. I love your shows, but the brevity of the episode was a pleasant surprise. Short and sweet, but very informative and excellent feedback letters. Loved hearing about the young British officer and how much has been garnered from your show. Great stuff. The trading options data was extremely interesting, but not unsurprising. Never amazed me how many people opt for the quick rich path as opposed to time slow and steady. Time and consistent investing wins all the time. Closest thing there is to a sure thing. Congratulations to your wife on her upcoming retirement. It's been almost 3 years for me now, and it's truly a fantastic phase of life. Regards, Steve in London, Ontario. Thought that was nice to reach out.
Nice. Was episode 311 the episode where I was in Europe and you guys decided to read out the comment from somebody allegedly named Eugene Fama who said that you guys are 11 out of 10 and Mark is mid?
Yeah, we just share it with facts only.
Yeah, I just wanted to confirm that was the episode. Okay, got it.
It was that episode. Yeah, we passed not judgment, and
I know exactly who that is.
We always read them. It's nothing about you, Mark. It's just
nothing personal.
We couldn't skip it.
No, I don't blame you.
That wouldn't be fair.
As soon as I read that comment, I knew exactly who it was. I won't call them out because they're going to listen to this episode. But I messaged them immediately after. I was like, "This was you, wasn't it?" And he was like, "Yep, that was me."
Confirmed, yeah.
Confirmed.
Yeah, we know who it was.
Yeah, good stuff.
That's funny.
So the meetup this fall, hopefully, will still go ahead, even though possibly the book might be delayed a little bit. Mark.
Yeah, not delayed in any like administrative sense. Just I was talking to Dan this morning. I submitted my first draft of the book that I'm writing with Dan Solon called Wealthier, Field Guide for Millennials, and we're going to revamp, I think, some of the kind of the voice of the book a little bit, so it's more my voice and less Dan's. Even though Dan obviously wrote the book and he's the foundation for the entire thing, I think we want Canadian readers to really feel like it's me that's talking to them and less Dan. So I'm going to go back and revamp parts of it. So it's going to add a little bit to the writing process. I don't know if we'll be able to get it all done and published by September, which was the original deadline, but we're going to do our best to do that.
But you'll still be in town then, right? Because you're coming so you're in town in the fall, Dan's, and so we'll probably still do a meetup, but it may not be connected to the book necessarily.
Sure. Yeah, exactly. Yeah.
And a lot of our friends are in town then too, so it should be a good time to get together, including our friend who I think I alluded to being on the internet.
Who's that?
Jason, who was quite proud to be. This is what, episode 5 we mentioned, Jason?
Never heard of him. Who's that?
Never heard of him? Yeah. Kind of a big deal.
You think so?
He's coming on. We've talked to him about it. He's going to come on. We're just waiting for Jason and I are working on a paper together about infinite banking, which is the idea of shoveling all of your money into permanent insurance and then borrowing against it to fund your consumption. So we've got a paper that is mostly written on that. It has been for a while. But with the tax changes, we had to update the analysis. So it was like mostly done. And we're like, okay, nice. We got a final draft. And then the tax changes happen. We're like, oh, we have to redo everything. Because it's all about comparing like investing in a taxable account versus using permanent insurance. So that's at least one component of the research.
But isn't that your happy place, you guys?
Oh, we're having a great time.
I know.
It's still tedious though. That's the annoying part, is that doing the analysis is fun, but doing it for like whatever 8 different cases or whatever we have, and then formatting it into a paper is not as fun. Anyway,
it'll be a blast to have Jason on.
Yeah, once we're done that, Jason will come on and we'll talk about it.
We'll see if we can get him to come out of his shell a bit.
Oh yeah. Yeah, he's such a recluse, eh?
Recluse. We can build up some confidence in him to come bring his A game.
Yeah,
get on there.
Okay,
good. I'm out of content. You guys got anything else?
I think we're good.
We're good?
We're good.
Okay, as always, everybody, thanks for listening. We'll see you next week.